Hey everyone, Michael Manaskanian here again. So we are doing our live Q&A and deal underwriting session for the Wealth to Real Estate investment community on School. So just before we get into some questions and potentially some deal analysis, just want to provide a quick update. So one of the things that I will be introducing in the next few months is a 2-day in-person workshop. So not today, but a 2-day in-person workshop, probably a Saturday and Sunday. So it's accessible to most people. Since I'm located in San Diego, I'll probably do it in San Diego, maybe at one of our cool rental properties that we acquired creatively. And if not, we got plenty of connections and office spaces we can hang out at for a few days. And the intention of the workshop is to give you something actionable. We will literally, it's not a, hey, come into this thing and I'm going to just talk at you. I'm going to have speakers. That's not the way I do things. We're gonna go to this event. We're gonna have a very clear agenda of how will you be able to make money within the next 7 days, 30 days, learning this thing. And during the workshop, we're actually going to teach for 30 minutes, take action for 2 hours. Teach for 30 minutes, take action for 2 hours. Eat lunch, network. That's how it's gonna be. If this is a more of an intensive, right? You're gonna do things that will result. You're going to walk away with not just knowledge, but actions that you've done. If you continue to replicate, you will make money. And the 3 ideas I currently have in mind, not sure which one I'm going to do, not sure which one first, but you're not going to be surprised to hear it ties into our Wealth to Real Estate community. So one of the ideas first is how can you find motivated sellers, whether it's for cash deals or creative finance deals, sub 2 and seller finance. How am I finding those opportunities? One of the tools that I leverage a lot is PropStream to find good candidates for creative finance and cash opportunities to then be able to wholesale those to an end buyer. So put it under contract, wholesale it to an end buyer after finding the motivation. And you actually don't even need to do all the work. Maybe you find the motivated seller, you connect them with someone who can close that seller and put them under contract. And then you have a partner to do the disposition or find the end buyer. So the focus will be how to find those leads and have those conversations with an end buyer or with the seller. So that'll be one topic we'll potentially have the workshop on. Number 2 is going to be bird dogging, which very simply is how can you connect an actual and true end buyer to deals that they want to buy, right? Not just spamming someone with deals and saying, okay, here's this property for sale I saw on Facebook. Here's this property I saw for sale. I saw a sign or whatever. It's like, no, I know the buyer well enough that I know what they're looking to buy, where they're looking to buy, what returns they're looking for, what strategy they're looking to do, truly understanding your buyer. So then when you find opportunities, you can say, okay, I'm going to take this opportunity, this deal that's already under contract. I'm going to underwrite it and see if it's a good investment based on what my end buyer is looking for, and then connect that deal and analysis to the end buyer, and you make money for that amazing work that you've done. I don't think a lot of these bird dogs or connectors at the lower level that are just emailing you stuff over direct message or email or whatever, I don't think they should get paid for that service. It's barely even a service. It's actually just spamming me all the time with unnecessary opportunities that I don't want to be involved with because it does not align with my investing goals. However, if you are an intentional bird dog, right? Maybe we'll figure out a cool term for it, but an intentional bird dog who knows your end buyer and what they want, and you're connecting them to deals that they want to buy, you are massively well-deserving of the money that they pay you, the fee that they pay you for that, or even the equity that they offer you in those investments. And then the third topic would probably be capital connecting, right? I can teach people how to do my entire business model, right? Buy and hold a $15+ million real estate portfolio, leveraging creative financing, off-market deal finding, raising capital, operating and all that. But that's not going to make you money in 7 days, 30 days, where I think the focus should be, how can we make you money while you're developing skills as you work your way towards being that end buyer, the end buyer of a large portfolio that's generating $100,000+ in cash flow. You got to work your way there. And that's what the focus of these workshops are going to be, developing skills and actions you could do to get to that point. And the third one I mentioned was capital connecting. So how can you find a true end buyer who needs more money to buy their deals? You're going to raise the capital on their behalf. You connect the capital to that end buyer and you get paid for raising that capital and helping that end buyer actually get the sale through. And so you're deserving of those funds. So you can see it all paints to that same picture, right? All I'm doing all the time is generating leads, analyzing them and determining which ones I want to buy, raising the capital to buy them, connecting all the dots, and then operating my properties and making sure that they are performing well. Those are the exact skills I want to teach people and show you how to make money during that. But sending you through Zooms, sending you to YouTube and whatever is not going to be the way to do it. It's going to be an in-person intensive workshop where we are actually working on these very specific things. Just for reference, if you are interested, just email me, let me know which of those topics you're interested in. I'll post a poll in our Wealth to Real Estate community. For the 2-day workshop, I anticipate somewhere between $2,500 to $3,000 for that 2-day workshop. They'll be all in. You'll walk away with more than enough information and action items to be able to recreate that business model, or like recreate that action to continue making money during this process. And you'll have something tangible to walk away with, a skill that will generate you money for as long as you continue putting in the work. At the end of the day, you're not going to make money if you don't put in work. I'm not here to sell you some fake thing, right? You got to work to get the results that you want. Whether you want to be a buy and hold investor, a lender, a bird dog, a capital, like whatever you want to do, you got to work. It just depends on how much you want to work. If you want to be passive, have a bunch of money and invest in index funds, that's passive. Do that. I'm all for that too. If you don't want to work, that's a great route to go if you're open to investing in stocks and index funds. If you want better returns or don't have all the money you need to just passively invest in index funds, you're going to have to work for it. But I can show you through my experience and through, the skills that I've developed, how you can streamline your journey to financial independence by leveraging all this. So that's the end of that. Once again, if you're watching this on YouTube, check out the school community, our school community, Wealth to Real Estate. We have over 250 members as of now, buyers, lenders, capital connectors, connectors in general, but intentional connectors, wholesalers, things like that. And then we do our weekly live calls. So with that super long intro out of the way, any questions from anyone in here currently before we proceed maybe with a deal analysis? Yeah, Nadine, go for it.
Sorry, I had to unmute myself. First of all, thanks for all the value you provide us, Michael. This is awesome. So my question to you is, I had an interesting conversation this morning with another investor who said that she's been networking with a lot of private money lenders, and quite a few of them shy away from the whole co-living model. They don't want to invest or lend their money for that type of model. And I was just wondering if you had any experience with that.
Right. I'll even take you one step further, one step even back first. So I raised plenty of capital for our co-living. I love our co-living properties. When I look back and analyze and I have a fractional CFO who helps me out too with analyzing past performance and projections moving forward. So I do have extra support, right? But looking at the deals that have performed the best for us, they are co-living properties. And for co-living, we have the rent by the room or Padsplit model. And we have our sober living homes where, we rent it out to a nonprofit or some operator who's going to manage that property as a sober living home. Those are our massively best performing assets. And not only do they typically tend to, so I'm making the case for this first, and then I'll get into the capital raising. But as someone who owns and operates these types of properties, they are our best performing assets. They tend to generate the most cash flow. The sober living homes are very passive once you put the operator in place. Rent by the room Padsplit is not necessarily passive. However, it's got very outsized returns. And typically your tenants are in there for a few months at a time, if not longer. They understand kind of, you're sharing a home, you're going to stay in your room, you're going to share the common areas and be respectful, but that's really leans into your management. And the reason why I like co-living over other strategies is because if you want the same cash flow or the same cash on cash return for a long-term rental, your best bet is to go buy a $50,000 home that rents for $1,000 in Missouri if you want high cash flow, high cash on cash return. That's what long-term rentals, the best long-term rentals are conducive to a property like that. 1 bed, 2 bed, really cheap neighborhood, or like lower, CD neighborhood, CD market. It's not going to appreciate massively over time because it's more focused on cash flow. Where on the other end of the spectrum, a rent by the room model, that's your management strategy, you are going to get solid returns, 12% plus typically. And the properties we're buying are way better. They're in better markets, like they are only in primary cities, the great cities in Florida and Texas and San Diego and North Carolina and South Carolina, like big cities, not just small cities, because typically people rent by the room in big cities. So you're in a better market. Typically you're in C and B neighborhoods. You're buying bigger homes with bigger debt, which in my opinion is good because as long as you're getting the cash flow returns you want, the bigger the debt, as long as you can make your cash flow positive and pay back your lenders and partners, the bigger the debt, the bigger the property, the more appreciation, right? Even if it's the same percentage, 5%, but 5% of $1 million is 50,000 rather than 5% of 100,000, which is 5,000, right? So you would take 10 of those properties to get the same level of appreciation. The debt pay down is bigger because it's just a bigger loan amount. So as long as it's cash flow positive, someone else is paying down a bigger portion of debt for each month. And the tax benefits are bigger because the loan is bigger. So there's more interest payments and then the property's worth more. So there's bigger depreciation. So it's less property. If I want the end goal is a $10, $20 million portfolio that generates X amount of cash flow, assuming both of them get there with the same amount of cash flow, you're going to need more properties that are long-term rentals than these bigger properties that work well with other strategies. But just understand there is inherent risk involved, right? Bigger debt, larger mortgage you got to pay each month, all that good stuff. So that's my case for why I like rent by the room. Bigger properties and better locations, and then better overall benefits of real estate investing, assuming cash flow is like equivalent between the short-term rent, the long-term rental, and a smaller, the best type of long-term rental, Missouri, 1-bed, 2-bed, property, whatever. So then capital raising. The issue is partially what I'll say. There's a few issues typically when it comes to capital raising. When I am lending money, or even when I'm educating on capital raising, people should always evaluate the deal first. The deal has to make sense. You have to be able to generate the returns that you are offering to your private money lender or private money partner. That's like foundational, regardless of who you invest with. That should be something that's evaluated every single time for every single property, every single investment. But then the next biggest thing, just because the deal makes sense does not mean you're going to be able to raise capital. Then the operator is evaluated. The operator, what is your experience with buying and holding real estate? What is your experience with raising capital and deploying an investment? What is your experience with doing a rent by the room model? What is your experience with, if you're going to say you're self-managing it, what's your experience doing that? What's your success doing that? How long does it take you to do that? What does your team look like that you can support that type of growth, right? So it's a lot of the times when people say they're having trouble raising capital, either the deal is making this a no-go from the very beginning, or I guess, the operator itself does not have experience and they're asking for the private money partner or lender to deploy capital when they can't even trust them as an operator because they don't have the experience to do so. And I'm not saying that's the case. I'm just saying those are typically the two variables. And then if I take it one step further back, most people that lend money, at least as a private money lender, they are used to lending a certain way. They're used to lending on a cash property that's going to be fixed and flipped. And in less than a year, they're going to get all their money back plus their interest because the property is going to be sold, or they're going to fix it, force the appreciation, cash out, refinance, and then pay back that private money lender. That is 99% of the way capital is raised. Well, that's not what I do. I mean, I do that. We have two right now, but typically what we do is we're raising capital for long-term buy and hold investments. That is not the common thing out there because there's a lot of extra concerns or extra different variables to consider. So when you're doing a fix and flip and you're going to pay back your private money lender, you're addressing the biggest concern, which is, okay, I know that this property is worth, let's say $500,000. You're going to renovate it for $200,000. You're going to sell it for $1 million. I know there's $300,000 spread to cover closing costs, paying me back my interest, whatever, all that good stuff. So you're focused on equity, but for a property or long-term buy and hold, it's focused on the cash flow. Is this property going to generate enough monthly cash flow to be able to pay me back my interest each month? And then what do you do in a year when my private money loan is due, right? Well, if it's a cash deal where you're fixing, flipping, or you are refinancing, you have that answered. I have equity, we'll have equity, and we will be able to refinance or sell this property to pay you off. That's how it's addressed. For a long-term buy and hold, there isn't that level of certainty because you're not going to sell your property after 1 year. Typically, you're buying a property at If you're buying it creatively, you're buying it at or near market value. And then you're adding this additional debt on there to acquire the deal. So you're at least at best, I mean, don't get me wrong, we've walked into plenty of deals with equity, but typically you're buying them at market value, if not even negative a bit, because of the fact that you had this second debt to come into it. So then how do you can't sell it in a year. It's not going to appreciate enough to sell it in a year. You're not going to refinance it. Otherwise, you're getting rid of, for my examples, 0%, 2%, 3%, 4% interest rate debt. I don't want to get rid of that. Like, so what we do is we refinance one private money lender with another one once the asset is stabilized. So typically, or, at that 1 year mark. So if I raise 50,000 to enter this property at 12% interest rate for 1 year, the goal is to get the property operational, get it ready, get it rented, prove the concept that this property is going to perform and that we're generating enough cash flow each month to pay back the interest of our lender. At the end of that year, I might have some surplus cash flow. I can pay $5,000 of that $50,000 loan off, but then I'll bring in another private money lender to replace that existing private money lender. So let's say 50,000, I paid off 5,000. There's still 45,000 that needs to get paid off. Another private money lender, instead of refinancing the whole debt, right? The mortgage and this debt, I'm just bringing in a private money lender, refinance that second position, that private money lender themselves, typically at a lower amount and at typically lower interest rate, because now it's a more stabilized asset. So this asset is lower risk because now you've proved this concept for a year. If it made sense at 12% PML at 50K, it's definitely your lender is much more secure at 10%, 45,000, because now you have even more cushion than you did the first go around, right? But you have to trust that the operator is capable of doing that, right? Like you have to trust the operator is capable of doing that, or that they will be able to sell the property, refinance the property, which is not likely in 1 year, full transparency. And I'd let everyone know, you're not going to have the equity more than likely to sell or refinance that property in 1 year. So you need to work, how are you going to pay back that PML? My business is especially unique because my business partner and I do not need any of the cash flow that we generate in our $12+ million portfolio together. I have a separate portfolio, then our portfolio together. We don't need that cash flow. So we're a little bit more secure because we're not worried about like pulling money out or whatever. We can take that excess cash flow between our portfolio and use that to pay off the private money lender. Let's say we've accumulated our business, the 45,000, we can pay off that private money lender ourselves if we wanted to. We can self-fund it separately if we just wanted to cash them out between our other income streams. But the more than likely it's going to be that we're going to refinance them. Well, that's what we actually, not more than likely, that is what we always do. We refinance our private money lender with another private money lender. So you have to be able to communicate that effectively if you're trying to do a long-term buy and hold first, even if it's a long-term rental, short-term rental, mid-term rental, sober living home, assisted living home, Padsplit, rent by the room, like whatever your strategy is, because you're raising capital, not on a fix and flip, focused on equity where they are secured. Their security comes from the equity spread. So if they need to take over that property, they're taking over a property with equity in it. And if the bank needs to sell it early or whatever, it needs to get sold early, they know they're secured because they're going to be able to pay off that debt. Where in a long-term buy and hold, the security comes from, is there excess cash flow? And if you had to be the one to take over that property because the buyer operator failed to perform, do you feel happy with the returns that you would generate on that? And do you feel confident in the operator themselves to be able to execute all these different steps? It sounds like it's worse to raise money or to provide security for a long-term buy and hold than a cash deal, like a fix and flip. And I would argue potentially. However, I think there's actually less variables involved with a long-term buy and hold than there are with a fix and flip, because the fix and flip, you're purchasing the property, right? But then you have to renovate it. So you need to get quotes on how much it'll cost. And if you've ever flipped a property, it usually takes longer and it costs more than you're anticipating. So you should always account for that margin. Some people do, some people don't. Some people are overly optimistic and think, oh, actually it'll be 10% cheaper, whatever. So the rehab can take longer or cost more. And if it takes longer, now your carrying costs go up. If you have a hard money lender in place, then you have to worry about, when that loan is due. And then on top of that, when you sell the property, you have to worry about, is your after repair value, the property value you thought it was going to sell for, secured? Like, is that a reasonable sale price? I mean, And then as we saw, right, people were starting fix and flips early 2022. Well, interest rates change. They have no control over that, right? Interest rates are changing. You have no control over that. If they change drastically in a short time period, prices will suppress, or at least volume will go down. And there's less properties, or people are buying less properties because interest rates went up. So then maybe to sell it, you have to reduce your price even further to be able to sell it. So there's all those variables, and some of that is just outside of your control. You can be on top of your general contractor, but if it ends up costing more, it costs more. If something comes up that you didn't account for initially, it came up and you have to deal with it, especially when you're doing an inspection without, like, if it's a full gut rehab and you can't see behind the walls, you don't know what plumbing issues there are, or electrical issues there are, or whatever, how long it'll take to get the permits, necessarily. Maybe there's delays for whatever reason. And the sale price is a lot of variables. For me, as a buy and hold investor, I think there are less variables personally. I can account for mostly everything, and the fluctuations are minimal. It's really, what are my expenses? What is my projected income? How quickly can I get this income going? And then the volatility of rent is much less so than the volatility of price, right? It's more predictable to get multiple comps for rent amount than it is for price. It is more challenging for rent by the room or pad split, but if you're focused on big cities where rent by the room is already happening, you have a lot of data points. We did it in one of our previous trainings. There's a lot of data points that will show you, on average, what is a room rent for with and without a bathroom, like with shared bath versus private bath, and how quickly does that property typically get rented? How quickly does the first room get rented? There are data points in these major markets. So if you're not trying, the problem is people try to recreate these strategies in markets that are maybe not conducive towards it because it's the only way to make the deal work theoretically, but it actually cannot be acted upon. But if you have real comparables, real rental comparables in that market showing this is the data, it's very, there's no such thing as a safe investment, right? It's always a balance between risk and reward, right? The more risky, typically the more reward. The less risky, the less reward. Hence why one private money lender up front gets 12%. The next one that comes in with a stabilized asset gets 10%, right? It's the same concept, risk to reward, and just understanding that there is always risk involved, but for this higher reward, right? It's less risky to buy that $50,000 home in what did I say, Missouri or whatever, than it is to buy that rent by the room 10-bedroom property somewhere in Florida, Miami, I don't care, whatever, or Jacksonville, Florida. That's like a common one. So all that, like, I mean, there's a million reasons why it's hard to raise capital on these deals, but you have to identify, is it the deal itself or is it the operator that's the issue? And usually it's usually the operator. I mean, the deal, well, they're both an issue typically. People are really bad at analyzing deals. They don't know what they're doing and they're hoping for the best case scenario. Where when I analyze, I'm actually hoping, I am underwriting it in the worst case scenario and I'm hoping for much better. Right. I'm hoping for much better, but I'm underwriting it in kind of that worst case scenario. We have vacancy, we have reserves, we have property management, we have all these things that we're accounting for, all that good stuff. And then for, let's see. Yeah. So usually the deal has to work for regardless of who you're underwriting with or whoever you're trying to raise capital from. The deal itself has to be great. Otherwise, why should someone invest? The returns have to be there and they have to be realistic. Sometimes unfortunately, people take advantage of inexperienced lenders and can get away with lying to them and saying, oh, this property, well, we did that last week during the training. Someone says the rental income is $2,000. We can't find any comparables above $1,500. Well, at face value, if you underwrite at $2,000, the deal makes sense. $1,500, the deal makes no freaking sense at all. You're losing money each month, right? So knowing how to analyze that deal, so the deal has to make sense, and then the deal has to be realistic, right? You can't fake your income and just say, oh, now it makes sense. And then secondarily, the operator. What is the operator's experience doing this? In my opinion, if you are a new operator, you should be giving up a lot more, give up a lot more ownership, right? At this day and age, I'm giving up between 10 to 40% equity to my private money partners. It depends on the deal, the entry cost versus the overall property value. It depends on a couple of variables. It depends on the cash flow they're going to generate, their cash on cash return, their overall return on investment benefit, ROI, their return on investment overall, where the property is located. Will they be able to stay at this property? For example, it's a short-term rental, or is this just an investment that we just generate income off of and we don't get to stay at? There's a lot of variables in the percentage that they get, but the returns that they're typically going to get is 7% with our conservative underwriting, cash on cash return. Their ROI will be 18+% typically, 20% is more likely. And that is what our private money partners typically get. That is our anchor, because the fact that we can raise private money, raise private money loans at 8% and above. So we have to kind of put it somewhere, and especially because they're getting all the ownership benefits that a private money lender wouldn't get. So, yeah, so the operator, yeah. So typically if you're a new operator and you've never done the strategy, you're going to give up a lot more. And in my opinion, if this is your first time doing that investment, I think you should use some of your money to invest in that deal as well. So if you're raising $50,000
in the game.
first pad split, you split and you say, hey, I'll put in 10 or 20 of it, or 25 at 50-50, and we'll split 50-50, whatever, to get a few deals under your belt. So then it's much easier. So then you get to my point. You get to where I'm at, essentially, because people see where I'm at and I'm like, yeah, but I also had to give up 50% the first time I raised capital. I also had to, I had to prove myself too until we get to that point, right? I had to build my resume as an operator, as a buyer, before I could just expect the best case scenario, which is kind of where we're at now, between 10 to 40% giving up ownership, not 50% in every deal. Hopefully that makes sense. I mean,
It does. I think, so initially I was thinking, with co-living, pad splits, you always hear about how, for the majority of the time, they're high performing assets. But I think when we talked this morning, the issues with these private money lenders were, should the buyer, even if it pencils out, they could see that the deal looks good on paper, but if the borrower were to default and they have to reconvert the rooms, the 8 bedrooms, back to 4, how much money would that cost? And that is what the deterrent is.
That's not a lot. It's going to take you like 5,000 or 6,000 to build out these rooms on the higher end, depending on walls and all that, and to demo roughly similar.
Okay, so those are some of the objections that I heard. And so I was thinking to myself, like you say, let's say the reserves that we're putting aside, right? Like the CapEx reserves, would that then cover? I was thinking, well, could we tap into that? Could they tap into that if they were to?
You can do whatever you want. You know what I mean? You can do whatever you want, as long as you outline it in your operating agreement if you're owning that way, or your JV agreement with your partner if you're owning, like depending on how you set up your ownership for that property. You can structure it however you want and say, hey, we're always gonna have 10K set aside as extra reserves if we need to reconvert the property back.
Yeah.
Or you just decide unilaterally, hey, we're going to do this now. You can do whatever you want. That's the cool thing. Every investment, you're like a mini entrepreneur, is a mini business. You set it up the terms of your business however you want. Yeah, I will say I do love my rent by the room and pad split, but I do like to make sure that if I had to rent it out as a long-term, or like if I had to rent it as a long-term, it's not going to massively lose me money. I understand it might lose a little bit of money as a long-term rental, but I can get really great returns as a rent by the room or short-term rental. But I don't want to be put in a position in which I'm losing $1,000+ a month because I'm forced to do a long-term rental because nothing else worked. And I like to make sure it has multiple exit strategies that are available. But I do buy properties that are exclusively one strategy only. Like certain properties, like a $2 million property I own in San Diego, works the best as a short-term rental. As a midterm rental, or even a rent by the room, it's pretty much cash flow neutral. And as a long-term rental, it makes no sense, right? But that's me. That's my risk tolerance. You don't have to do that. That's the cool thing about being an intentional investor. You can structure it based on where are you at. Typically, most people starting a portfolio should be focused on cash flow over the other benefits of real estate investing. So I wouldn't do anything that could jeopardize my cash flow early on. Buy that I had millions of dollars in real estate before I bought an asset like that was not just focused on cash flow. Hopefully all of that, I'm just kind of provide a lot of different value on this topic.
No, absolutely.
More specifics.
Thank you. No, that was great.
DJ, do you still have a question? Yeah, go for it, brother.
Yeah, thanks, Michael. I was just curious, when you were talking about the lender that helped you acquire the property getting 12, and then someone say a year later they want to pull out, and then the next lender you swap in is getting 10% for, say, the 45 in your example. Is that always driven by a lender wanting out, or do you drive that decision as well? If they, for instance, if the person making 12 was cool to do that for 5 years, do they
Right.
just stay in it, or is that something you drive and say, you know what, this is kind of more seasoned, I'm going to swap them out for somebody else that wants less?
Right. I don't know if anyone is as direct and as transparent about this stuff as I am. And I posted within various communities about this topic too. Various things where people are just like, man, thank you for sharing this stuff. Because I think of these things theoretically or whatever, but no one that is actually doing it is sharing how they're doing it. So the way that we do it in our business is at the end of that 1 year, well, before the 1 year, probably 2-3 months prior, what we do is we reach out. Usually we have a good indication too at that point, but we'll reach out directly and say, hey, private money lender, we always give you first right of refusal. Do you want to just continue the loan as is, typically, or we'll say, hey, or we go to the 10% route for a longer hold period or whatever, but do you want to continue being a private money lender on this deal? If we are willing to offer it at the time, maybe we want to convert the PML to a PMP. If we're willing to offer it, would you want to keep your money in as a private money partner now? Or then we would refinance them or, pay them out, I guess we'll say, regardless if we're going to refinance them with someone new or pay them out, however. Does that make sense? We always give our lender first right of refusal to continue on, maybe at the same terms or at a lower interest rate for a longer period of time. If we're going to offer a conversion to private money partnership for whatever reason, we would ask them first, and we have done that before. We'll ask them first, and if they don't want to and they want to get cashed out, then we'll bring someone else in. We always prioritize our existing lenders and partners. That's just the way we do business. I mean, I can't say what's better or what's worse. I mean, I think it's logically more easier to do what we're doing, just like more efficient because they already have that person there. But that's what we always do to take care of our lenders and partners, if that helps.
Yeah, it does. So it's kind of triggered by an annual review then, it sounds like.
Yeah, because based on whatever the term is for our original PML term. Usually, like I tell people 12%, 12 months, because it's easy, right? 12%, 12 months. We'll reevaluate then, and it's easier for me to raise capital when I'm doing it for one specific thing, for one strategy, for when we're acquiring deals. 12%, 12 months when we're acquiring a deal. And then that's why I mentioned the private money partner terms too. Like I was very transparent. What are we offering to our private money partners? And what can they anticipate on every deal? Because then it's really easy for me to say, hey, if you're a private money partner for me, these are the returns you will anticipate next time you see a deal, regardless of where it is, what strategy it is, you can anticipate roughly these returns. For a private money lender, you can anticipate these returns, 12 months at 12%. It makes it easier and more systematic to raise capital too. And as an engineer, I like standardized processes, and the more variables, the more changes there are, the more challenging it is to do it. Because now I'm saying, hey, I know, I didn't give you a percentage, but now we're offering 10 and now we're offering 13 and 8 and this and that. It just gets confusing as opposed to this is what we offer for the first time when we're buying a deal, 12%, 12 months. It works out to everyone's advantage.
Gotcha. That's very helpful. Thank you.
Of course. Any more questions, y'all? I know usually once we start down a route, we continue down that route. But I'm here for you all. Questions, underwriting. Otherwise, we call it a day.
Yeah, I'm kind of curious about how you structure your deals with your PMPs.
Right. Okay. So I kind of referenced that. But in general, we're giving them, it's less about ownership and all that stuff. First and foremost, the thing I try to have our private money partners, who are prospective private money partners, understand is you are almost always going to be offered an investment opportunity where you'll take over ownership of the asset, somewhere between 10 to 40%, depending on the entry, like all those variables I mentioned. But the main things to focus on, the things that will always be consistent, is we will adjust the terms, maybe the percentage of cash flow they receive, or we give them a preferred return. So their cash on cash return for the money they invested based on the cash flow, right? The annual cash flow divided by the amount they invested, the annual cash flow that they generate divided by the amount they invested is going to be right around 7%. Always. Because that has to be lower than our private money lenders. Otherwise, I should just use a private money lender. Why am I giving up ownership of my asset, causing way more work for me? All this tax return stuff I got to do because of partnerships, all these extra things. Why would I do that if I could just get a PML? There's other reasons. I mean, part of it, we do love partnering with people and all that. But for the most part, that's a factor. That 7% cash on cash return is what they can anticipate, at least with our conservative underwriting. Doesn't mean if they get more than 7%, like we're not going to stop them at 7%. If the property performs better or we don't need to tap into our reserves as much or whatever, we don't have vacancies, whatever it is, they're going to get higher returns. But when we're underwriting conservatively, I'm saying, hey, this is kind of the floor that we're looking at for you, is around 7% cash on cash return for this deal, for every deal, but for this deal in particular, but for every deal. And then their total return on investment, when you account for their ownership split and the corresponding appreciation percentage, right? The appreciation they're going to get on the asset, the depreciation and other tax benefits like interest pay down, those tax benefits, and you account, and that depends on your tax bracket too, but and your debt pay down, that will collectively get you typically in total return on investment, right? In conjunction with the cash flow, get you a total return of around 18% or higher, right? So those are the two numbers I focus on: 7% cash on cash return, ROI of 18% or higher. That's most of our deals are going to be right around that amount. And then the percentages of ownership and all that, that one's a little more tricky. You're going to give up more early on, and then you're going to give up less later along your journey. But ours are between 10 to 40%. Typically depends on the typical main factor is entry cost to the value of the property, and what does the cash on cash return and ROI look like? What percentage will get them to those terms that we're looking for?
Awesome. Thanks, Michael.
Of course. And I think people need to understand is when they're raising capital early in their journey, especially the first few deals, you're not locked into that forever, but you are going to need to make it enticing enough for someone to believe in you early on to raise that money and buy your asset and prove yourself, right? The first few deals are just proving yourself. So then you can raise deals at better terms, lower interest rates, lower ownership percentage you're giving up, whatever, but you got to start somewhere. You can't look at where I'm at and say, hey, I want to do this too. You might have to give up 12% cash on cash return. You might have to give up 50+% ownership. You're going to know when you start connecting with people. That's why I say being an intentional bird dog is a great skill set. And then being an intentional capital connector is a great skill set. And what that means is someone is on my list, right? My investment list. And I'm saying, hey, I'm raising capital for this deal. I need $100,000. Here's my marketing. Here's the returns we're offering. You take that information, you raise capital on my behalf. If you are able to find someone that wants to fund that deal, I will pay you for that connection, right? If I wasn't able to raise the capital on my own, obviously beforehand, I will pay you for that connection. And you are developing your skill set of raising capital on deals that have all of this information already provided. Because if you're trying to raise money for your own deals, what work do you have to do there? You have to define leads. You have to connect with them, underwrite them, put them under contract, develop all the marketing material, know how much capital you need to raise, push that out, all that stuff. As a intentional capital connector will say, you already have the marketing material. You already know how much to raise. You already know we have a proven track record as an operator where you're working on that. Like it's way less variables, but you're developing that skill set of raising capital and deploying it on deals and just focusing on the ability to raise that capital. Nothing else. That's the skill set you're developing. That's what you should be focused on. If you really want to be really good at capital raising, start there and then expand onto trying to do this all for yourself entirely. Because at least now you have a track record, which makes it easier for the next deal and the next deal and the next deal. Real estate, everything gets easier as you compound your experience and skills and you're getting better and you're proving yourself, you're building your resume. It all just gets easier over time. The way I raise capital now is way easier than when I had to do my first deal. Even with interest rates going up, it's easier for me to get the same or better terms now than I was getting 2-3 years ago. It's just the fact. And it's going to be the same thing for everyone else. So you have to understand that. Not you in particular, but people have to understand that you might get great returns or you might get great terms for your loans, but it's okay to start somewhere, even if it means intentionally capital connecting and then giving up 50% ownership or self-funding a part of the deal and then raising it all outright at great terms. Like this is if you really want to do this thing, this is a longer term thing. It's not the one deal. It's not 1 month of work. You're developing these skills over a longer time period and everything gets easier with more experience and more time. As long as you're taking action. If you're sitting there in Zooms and YouTube videos, nothing's going to change for you. I mean, that's the fact of the matter. So then at least intentionally connecting capital is going to develop your skill set to raise capital, one of the best skill sets you can have out there for anything, not just real estate, for anything that you're doing, and then get paid in the meanwhile while developing your skills, not just watching Zooms or YouTube videos or recordings of this thing or sitting in a school community or whatever, right? It all has to do with action, like learning, implementing through action, executing, right? Executing that. And then like, okay, how do we improve that? Restarting. Maybe it's more learning, action, just keep that cycle going and it gets better and better over time. Because you're not just restarting that cycle, you're actually restarting and you're at a higher floor, restarting at a higher floor. It's always going up. It just doesn't feel that way throughout the journey, but it literally is always going up as long as you're doing the right things though. I mean, if you're, yeah. So I'll leave it at that. Hopefully that was helpful.
Very sage advice. Thank you.
And all I can share is based off my experience and then also those of my mentors who I work very hand in hand. I don't have a lot. I'm very simple. I have one for capital raising and I have one for creative finance. And the creative finance one is a little disingenuous. We do a lot more than creative finance, but nonetheless, like between what I've been able to accomplish in less than 4 years, $15 million portfolio, massively cash flowing, awesome portfolio of properties that I want that align with my overall goals, helping others along that, like the majority of that time, at least with deal analysis. And then what my mentors, how much they pour into me, I just want to share that with other people just to expedite your journey that much better. Because if I was to restart my journey, I would have skipped wholesaling. I mean, I wholesaled over 100 deals and generated a ton of assignment fees during 2021 and 2022. But if I was to restart, I would have skipped that because that skill set didn't necessarily benefit my buy and hold business overall. I just thought that was something I had to do to scale. What I would focus on is, well, I would do what I did. Actually, first thing I did was house hack a multifamily property. My wife and I lived in one unit, rented out the other. I would always start with that. If I had reserves and employment, I would leverage those opportunities. As a veteran, I have the VA loan 0% down. Even if you're not a veteran, you have the FHA loan at 3.5% down or 5% down conventional loan. You should be able to do that if you're wanting to get into real estate. You should be able to save the money to execute something like that. It's a great way to start, great way to build your portfolio, and now you're an owner of assets. And then I would have spent time bird dogging intentionally for real buyers. So I'm connecting with them. I'm adding, people say, how do I get a mentor? How do I get a mentor? Add value to someone who's ahead of you. So bird dogging for someone saying, hey, I want to bring you the deals that I know you want to buy. I'm even going to underwrite them for you. And I'm just asking for a small fee when you close on these properties, not when I send them to you, but if you close on it, I just want to get paid a small fee at closing, right? That is a tremendous skill set. That is a tremendous proof of concept. And then I would do the same thing for the capital raising the capital for other people's deals who are proven operators. Those are amazing skill sets that then directly translate to your ability to create a massive real estate portfolio, finding the right deals, raising the capital to do so. And then now your big skill set is operations. How do you manage the operations of a business like this, especially as you continue to scale? That's then like the big next skill to develop. I can't teach you operations unless you have assets. I could teach you, but it's like theoretical right now. Capital connecting, bird dogging.
You've got a pretty decent online presence. How much of your success being able to raise capital would you attribute to, your exposure on social media?
So as of this time, I have 200 YouTube followers or whatever, subscribers. I have less than 3,000 Instagram. I mean, Facebook, I don't know, friends, but I don't know. I don't really post on there except in the real estate investing communities because I'm still somewhat shy about sharing, just the way I am. Immigrant parents, my wife as well, like the way we communicate. We don't like to share. We're like stealth wealth has always been the way that we do it.
Oh,
and
well.
more recently, when I realize it helps other people if they know what I'm actually accomplishing, not just that we're just doing this and I'm investing all this money without, silently. How much does it help? It definitely helps. Like I met a lot of people in here through that, but I think really what helps is these events that I go to, connecting with people directly with them, building relationships with them really helps with capital raising. I have rarely raised capital from people that I've not built a relationship with first. So full transparency in that regards, like I've built relationships with these people first, whether they're investors, lenders, buyers, even if it's just a 30-minute Zoom, at least we're connecting and understanding each other on a personal level. And then, So how much it doesn't hurt. It definitely does help. But for me, the big presence that adds a lot of value is people know me as the intentional investor or the creative engineer or whatever. They know my biggest skill set is deal analysis and understanding what is a good deal and what is not a good deal. If you had to shift the terms of a deal to make it a good deal, I know how to do all that. I know that I'm raising the right amount of capital. I'm not just raising them out just to barely get into the deal. We're accounting for the rehab and reserves, the rehab and furnishing costs, if that's the route we're going. We're raising reserves for the property just in case something goes wrong early on. We have the money set aside to take care of that, whatever comes up. I think that plays a big role into my ability to raise capital, because I'm constantly showing people how I'm analyzing deals. I'm putting myself out there and showing people how I'm doing these things, what I'm consistently doing, how I'm raising capital, how I'm buying deals, how I'm negotiating them, whatever. I think all of it helps. Obviously, it's a huge factor. It's a lot harder to do it silently, I'd say. And I still haven't even tapped into this 1% yet. For the amount of people out there that have 100,000+ following for the 3 or 5 deals that they have, like, great, that's amazing for them. But then they create coaching and mentorship and all that stuff just like that. I'm like, dang, you should prove yourself first before trying to sell someone a bill of goods when the market shifts and you can no longer do what you're doing. I've been able to buy traditionally since 2020, live in properties in my local market, out of state, creative finance, cash, traditional, whatever, commercial, raise capital, using my own capital, whatever. People should do that before they start trying to teach other people, in my opinion. But people have really big social followings because that's what they prioritize over building a portfolio and building their skills. I did that opposite. So for me, it's a lot easier now to build my social presence because I have such a big resume over the last several years of the things I've been able to accomplish. So I'm kind of in the opposite, and it's an advantage, but now I need to shift myself into a mindset of someone who creates content and all that. And that's not my thing. I'm like this. I talk to people. I don't sit there and create reels of, okay, what's going to catch someone's eye. I understand the value. I understand the value of it now more so than I did before.
Okay. Awesome. Well, I'm not complaining because I love this. I love this setting.
Awesome. Yeah, me too. I
Thanks,
love the small group. I love the live. I love this a lot too. All right, I'm going to wrap it up because if we get into another question, it's going to take another 15 minutes. As always, we do our weekly live calls. We just shifted the time 30 minutes back moving forward. But join the school community if you want to be part of it live. You want to be part of the recordings. It's in the school community once you unlock it. It's also on YouTube eventually. So you do have access to that. But if you want to be part of these live, you got to be part of the school community, Wealth Through Real Estate. So thanks, y'all. Have a great rest of your week. All right.
Thanks, you.
Michael.
Thanks, Mike.
Bye, y'all.
Bye.